Hey, Drew, how's it going today?
Hey, good, Derek. How are you doing?
Oh, I'm good, good. Thanks for watching our video today, guys. Today, we're going to talk about SPIA annuities and equity index annuities. So, what exactly is a SPIA annuity, and why are we comparing it to an equity index annuity, Drew?
Yeah, it's a great question, Derek. So, a lot of people, when they think about when the layperson thinks about annuities, the single premium immediate annuity, the SPIA, is what comes to their mind. These are fairly simple instruments where you take a single lump sum premium today, you pay that premium to an insurance company, and in exchange, they guarantee you income for life. So there's a lot of people that may benefit from that concept. Very simple concept. We take it a step further, and we're going to introduce the topic of consider your alternative, which is an equity index annuity. So maybe you can tell them a little bit about that one.
What an equity index annuity is you still give the same lump sum of cash to the insurance company, and they will take the premium and they'll indirectly invest it in common indexes like the S&P 500, the NASDAQ, Fidelity, Morgan Stanley. There's all various indexes to choose from. And although it's not guaranteed to grow, there's a great shot that the NASDAQ, for example, will be a lot higher in 10 years than it is now. And if that's the case, then your equity index annuity with this lifetime income rider is going to leapfrog and will pay you much more money, income for life, than the single premium immediate annuity. Now, when's a single premium immediate annuity appropriate? It's really appropriate for somebody who doesn't have kids, they have no heirs. They tell us, hey, Derek, Drew, I want to get as much income guaranteed right now, and I don't really care about a legacy. That's kind of when it might be in the ballpark of consideration. So it's really a niche product. For the most part, most people will go with the equity index annuities.
Yeah, it kind of provides a hedge of, well, we have a baseline. We have an income that's actually really close to a SPIA, within about 5% or so, in terms of if I turned on income immediately. But if you defer, say 3 to 5 years, or even as long as 10 years, you get a dramatic, more than a doubling of your income by doing that deferral. So for a lot of people in their like mid 50s, it's a no-brainer to do the equity index annuity because they don't need an income starting next week. A SPIA is great if you need an income starting next week. Think about that person who they won the lottery and they're horrible with their money. A lot of those people might benefit from something where they just get an immediate income that they don't have to think about. That's super simple.
That's right. Yeah.
It might be layered. You could do different. You could do a SPIA plus an equity index annuity. There's a lot of complex ways to do this, but keep things relatively simple too. So, yeah, so that's what we're going to talk about today. We're just looking at some numbers, like on a $250,000 premium. So, like you said, that lump sum premium, you drop that into the very best SPIA from a highly rated company on the market today, who I won't name just because of compliance, but we could certainly help someone find this. That 250 is going to turn on an immediate $17,760 a year income, which comes out to about 6.8% if you do the math on that. So a little better than just buying a 30-year bond, but that's turning on an immediate annuity. I don't think many people are going to be too impressed with, I'm going to give you $250K just to get back less than 18 grand a year.
Exactly. And so you really have to kind of use the tool that's right for the client. And so most of our clients are kind of in their 50s, early 60s. A lot of them aren't even retired yet. So they're not thinking about income just yet. So most of the clients we talk with, they have, 5 to 10, even 15 years of deferral. And that's where you can really take advantage of these high interest rates right now, because that 10% simple guarantee you can bank each year for the next 20 years. So after 20 years, it stops. But most people will have turned on the income by then. And if you do the math on deferring just 5 or 10 years, that lifetime income payment goes from 16K to what? It's got to be close to 40,000.
Yeah, I'm looking at an example we did with a really well-known company. It more than doubles, almost triples, even into 10 to 12 years. So that deferral is really powerful right now. And again, it doesn't fit everyone's circumstances, but a lot of the people we talk to, it does. If you're, say, in your 50s and you're looking to turn on some lifetime income once you retire, this is a perfect time to strike. We've got the market at all-time highs. Hopefully it'll continue, but a lot of people are concerned that we might have a pullback at some point. And if you move position a small portion of your assets into one of these instruments and the market pulls back, we're going to have a really fun conversation next year when your principal hasn't changed on this versus your stock investments, which may have declined if there's a market pullback. So it's a good way to just kind of lock in some gains with a small portion. Again, we're not looking to take everyone's entire nest egg and drop it into one of these things. That wouldn't make sense either.
We love the stock market. We feel that you should have most of your assets in the stock market, but kind of think of annuities as a bond fund replacement. Say a person retired in April of this year when the stock market was down 20, 30%, and they needed money at that point. They had no other sources. That means they would be having to sell, Apple, for example, at $150 when it's $220 today, or Nvidia got down to $77 and now it's $190. But if they had a portion of their assets into an annuity, they could just live off that income for a while until the market comes back. Because 3-4 months later, the market's way back up. Nvidia is approaching $200 now. So it almost prevents you from having to make these panic decisions because you're diversified. And one last aspect that we use as a tool with these equity index annuities with that income rider is there's a couple of them that will give you a 100% bonus on your income if you need long-term care for 5 years. As people age, they have a couple main concerns that we hear over and over. What happens if I need long-term care? And what if I run out of money? So those two concerns we hear all the time. And these kind of equity index annuities with that income rider, they do kind of help a plan for a couple of those retirement decisions that everybody's going to be faced with.
We sought out this particular product to solve a problem that our clients had in the real world. A couple of years ago, we started realizing that a lot of people wanted to buy hybrid long-term care plans, but they may not qualify, or there may be some other element about hybrid long-term care plans that they didn't like. Having said that, we still have probably the majority of our clients do go to hybrid plans, but for an increasing number of people, there was reasons why those weren't a good fit. And so we sought out, well, what's another solution that we can use to solve their problem? And to your credit, Derek, you kind of discovered this and experimented with some different options. And we've really refined the offering that we're suggesting to a lot of clients. And we have software here that compares over 300 different plans. And so we're constantly kind of keeping that radar on what's the best solution for people's problems today.
So, whether you have an old annuity you're thinking about replacing, or you have some money that you want to kind of maybe take some chips off the table and maybe sell some assets from the market and put them in some instruments that have some guarantees, we're happy to have a conversation with you. We're independent. We work with every single product out there, and we're laser focused on finding what is the best product. And in this case, a good company paying you the highest guaranteed returns out there. And it changes over the years which companies can be in the lead. And that software that you mentioned of 300 companies, it really helps us funnel down and track down which company at the time does have the highest rates. So if you'd like to learn more, we'll put the link to our page on the bottom of this video, or call us. We'll pick up the phone, or our assistant will. And if you miss us, leave us a message. We'll call you right back. But thanks for watching our video today. And we do these often, so we'll be here probably doing another one here next week.
Yep. And just one more thing. You mentioned briefly if you have an existing annuity. We did a video recently on refinancing your annuity. If someone has some money in an annuity that's 3 years old or older, watch that video and reach out to us, because we've been doing some pretty magical things helping people get higher incomes and just better returns on some of these older annuities because of the macro environment. Interest rates have risen. That's caused some waves in the mortgage markets and other places, but it's really helped annuities. So you can use that tailwind to your advantage.
So pretty much if you bought an annuity pre-2022, 2023 even, you can probably refinance it into a much higher guaranteed interest rate. Because right now, the Fed has not decreased rates yet. So we're at the peak of this interest rate cycle. So you can lock in at the high. So we're happy to help see if your existing annuity could use a tune-up.
All right, Derek, nice chatting with you about this topic, and we'll do another one again soon.
All right. See you guys. Thanks.